And good morning, good morning, good morning. Welcome to another episode, the final episode of 2020 of Money Matters. My name is Nev, and today's episode is probably the most important episode that I have ever done. Today, we're going to be focusing on real estate and predominantly talking about, of course, what's been going on in the real estate market overall. But what I will be focusing on today is really talking about something very important, and that is some of the exposing of the problems and challenges within real estate industry and why and how it's basically almost like the government wants us all to remain as broke as possible. Now, I know this sounds absolutely horrific to be able to share, especially, as we're getting into the most beautiful holiday season ever, and we're actually in it right now. But I think it's absolutely important that we discuss this and talk about it and talk about what the problems are. This is not just me talking about it. I'm going to be sharing with you the articles that are available right there online, so you can go and test it out, check it out, go and interview people, ask questions. But I'm telling you, what I will be sharing with you is also going to be talking and explaining why affordable housing is a myth. It's never going to happen, at least not when it comes to financing the whole thing. There are many, many affordable homes out there, but most people don't know it. When the media, mass media, goes out there to show you affordable homes, they take you to the projects to scare the living daylights out of you. That is not what we're talking about here. Then, when they want to show you beautiful real estate, they show you $500,000 properties and up. And of course, the numbers keep on going up every single year that they keep doing this stuff. But there's a lot in between the $1 million mansions and the projects. And today we're going to be talking about some of those things and some of the problems that exist within the market when it comes to these things. So I do want to welcome everybody who is watching this live. I do want to welcome everybody who is watching a replay. Hey, if you're brand new, smash the subscribe and notification button. And if you're liking the show, of course, do check the like button as well. I'm sure you're going to find it somewhere on the page. And if you are listening to the show as well on one of the podcasting services, I do want to welcome you as well. If there's some sort of review somewhere that you can write, hey, do me a huge favor and do that. Let's do this. All right, y'all. So we're gonna get started. We're gonna get started today, and we're gonna be talking about. Let me just fix my little camera things. We're gonna be talking about what's going on with the rates. So of course, we always like to know what's happening with the mortgage because these are very much tied together. An ability to borrow money to get into the house, while it didn't quite exist way back when at the beginning of last century, it's definitely here. It's not going away until the financial system as a whole changes, which we could actually see in our lifetimes, if you can believe it, right? It could actually even happen in the 2020s. Not 2020 per se, right? Because we have one day left in it, but 2020s for sure. So let's take a look. 30-year fixed rate is 2.66%. 15-year fixed is 2.19%. 5-year fixed is 2.79. I have no clue who actually gets a 5-year mortgages, but I guess people do. But it doesn't make sense because A, it's the most expensive one, and B, you can still get a 30-year fixed and pay it off in 5 years if you really desire to do that. So, in all honesty, 15 and 5 and anything actually less than 30 doesn't make sense in my humble opinion. But what the hey do I know, right? I've only been in the market for about, I don't know, 10, 15, 20 years. Who the hey? Who's counting? Who's counting? So let's take a look at what's going on here because I wanted to share something with you here. As you can see, we are looking at the what you're seeing over here on the chart is a graph, and we're looking at the Zillow version of the mortgage. And of course, they do take a location into the whole spectrum, but the nice part about it is you can play around with it. So I wanted to take a look and show you something. So if you go in Yeah. Wait. So if we go in, we're actually looking at a purchase rates with the credit rating of 740 and higher, paying 20% down or more. Of course, we're going to be located in the United States, and here is the 3 month. And you will see that there's something very interesting happening. The green line at the top is the 30-year fixed. The blue line down at the bottom is a 15-year fixed, right? And it makes sense, right? 30 years, it's a bit more expensive mortgage. 15 years, it's a bit less expensive because what the interest rate does, it basically accounts for time. It pays for time that you are taking the risk for, right? So, all cool, right? Then we switch it over to 680 to 740. And again, still 20% down. Everything is fine. Less than 680, right? Like you still see it, it's adjusting itself based off of the risk factor. Now, what I'm going to do is I'm actually going to change the percent down. You will see the 5 to 20%. We do see that there are healthy gaps that are occurring as well, right? Sometimes a little bit wider, sometimes a little bit narrower, but there are definite gaps that are occurring with this thing. Then we're going to switch into less than 680, 740, right? Did we play around with this? We did play around with this. This is the part that I wanted to share with you. Take a look at this. An interesting trend that has occurred. If you're looking to purchase a home and your credit rating is 680 to 740 and you are paying less than 5%, right? So you're potentially going into the FHA, right? The purchasing for 15 years is way more expensive than purchasing at 30 years, because you will see the blue one is 15-year fixed, and you will see it's approaching close to 3.5, whereas the 30-year is at 3.09. So something to pay attention to. Same thing if we go into the less than 680 for the credit and less than 5%, you will see that the 15 and the 30-year have actually crossed, right? So you can actually see that happening right over here. That is the brand new thing that actually just occurred. It looks like today, where the 15-year is starting to become a bit more expensive than 30-year. Now, why is that? That doesn't make sense. Well, you're right. It doesn't make sense at all, right? It makes sense that the 30-year would be more expensive than 15-year, and it makes sense that the 20-year is going to be more expensive than 15, and 15 is going to be more expensive than 5. But you also have to look at what people are actually wanting and what they're buying. And so what this lets me know is that there's not as much desire for the 15-year, because it just doesn't make sense, y'all. It just doesn't make sense. What they're doing is potentially taking advantage of individuals who are petrified and kind of wanting to go into it and saying, well, I'm going to go and get a 15-year mortgage, and then I'm going to, pay it off in that time. Where they could get 30, double down, still pay it off, and actually less than 15 for same amount of money. Something for you to probably know if you have been paying attention to the show and if you've been around here. So this is an interesting piece that I wanted to share with you. Now, I did also want to share something new as well, of what's going on with the existing home sales. Where are we with that piece, and which lets us know of kind of like what can we expect for 2021 to be like. So here is the sort of what's going on. Existing home sales have fallen in November, after the straight 5 months of increases, solid increases. And total existing home sales dipped 2.5% from October into November, right? So the inventory of homes for sale fell nearly 10% from October to a record low of 1.28 million units, which equates to 2.3-month supply. So we are hitting some super, super low supplies for the month. And I think that that's a very important piece for you to understand of what's going on. Because what ends up happening when we see something like this? Well, as long as the supply stays low and demand keeps on going high, we are going to see prices going on upwards. And that's exactly what we've been seeing so far. We've been seeing prices go upwards with the median home price exceeded $310,000 in November. That is up almost 15% from a year ago, 14.6% to be exact. This is the probably, I don't know that I have studied the history that much. I probably should have now that I think about it. But I don't remember in all of my studying and all of my reading ever seeing real estate market jump up about 15% year over year, just on the price, right? Nothing else accounted. Now, as a real estate investor, you likely are aware that you can go into the real estate, right, and you will easily can get, anywhere between 15 to 40, 45, sometimes even 50% return on your investment with just one rental property, right? Which is why I keep saying you're one deal away. You're one deal away. I just need you to make the deal, okay? So that's kind of where the thing is. But the fact that right now, right here, we are 15% just in price alone. So this doesn't take in the appreciation, or actually, this is just appreciation component of the thing. It doesn't take in any depreciation. It doesn't take in any tax savings. It doesn't take any passive income if you've made it, if it's a rental property. This is just a return on appreciation. So that lets me know that as an investor, if you have been having good quality tenants that have been paying and that have been basically caring for you and the property as much as you do, then in that instance, there is a high potential. Again, depends on what your rental is versus your value versus your carrying of the monthly, obligations and all of those different things. But there is a good potential that you could have made between 50 to 75, maybe even 100% return on your investment with just one deal in real estate. Because, right, when we account for all of the returns, you have to take in the tax savings, right? Because you do know that if you get into the real estate, that you can offset your active income with your passive income, with your depreciation, with all of the expenses and stuff that real estate brings, and bring down your taxable income legally. So this is one of the benefits that is absolutely beautiful about real estate that doesn't exist in any other asset class unless you own a business, at which point you can kind of like do some creative stuff within it. But this is the only one thing that is kind of like baked into the cake, which is why you see all the prominent individuals, all the wealthy individuals get into real estate. They may not get in everything into real estate, but they'll get some into real estate. And when I say they get into real estate, I'm not just talking about them buying their own home. I'm talking about getting an investment, although even buying your own home can help. Okay, so regionally, home sales have dropped on a monthly basis across every region except the West, where they were unchanged from the month before. So, what is happening? Well, the extreme shortage of inventory means we expect further evidence of rapid price increases. Such rapid increases in home prices reduce the implied real mortgage rate for potential buyers, thereby pulling in new buyers. Fear of losing out on the property ladder as prices rise can also be a powerful motivating force. So, what do we expect in 2021, contrary to the popular belief of everybody else on YouTube? Well, there is a good potential that the deal is going to be made out, right? They're not going to let people go out. Well, they might, but people are very afraid of the revolution, which I think one is coming. And as described in the fourth turning, there's nothing we can do about it. It's just it's baked in the cake, as I said it earlier for something else. It's baked in the cake, and there's nothing you can do about it whatsoever. So that's something for us to note. But if the banks go and foreclose on all the millions of people that are right now in forbearance, that is going to be hugely problematic. And I don't think it's going to happen for a couple of reasons. So There's few reasons for that. One, uh, right now, all of the people who are in forbearance have an opportunity to slowly but surely, if they can't rework some sort of a deal, they can go and basically sell their home. And right now they can sell their home because inventory is so low, they can sell it for massive gains. So not only can they actually pay off the home, take care of all of the financial challenges that they have, probably take care of all of their debt, and potentially still have money left over. Again, it depends from situation to situation. Everybody's situation is different, but there's a potential for that, right? So there's an easy out for that because there's still willing buyers on the streets. Well, I don't know if they're on the streets, but they're definitely online. So something for you to note and pay attention to. So that's number one. Number two, when we see new inventory hit the markets, there are willing buyers ready to jump in and get the place, especially if it's fairly priced. Number three is the banks, I think, have learned a lesson in 2008 when they foreclosed on everybody and then just tried to dump it into the market. And then, of course, what happened? Well, the prices tanked. Well, that didn't help the banks, did it? Because when the market was flooded and everybody was scared, nobody was buying, what happened? Well, the prices went down. As prices went down, more people walked away. As more people walked away, the prices kept on going down. And, next thing you know, you have a solvency crisis. Now, do I think we're still going to have a solvency crisis? Yes, it's a very potential scenario for 2021, but I don't think it's going to be rolling in from the real estate perspective. So we'll see how it goes. Looking at what the bonds have been doing, which they have climbed up slightly, and they're flirting with right around 1%. They're still at point 0.9 something, but they're flirting. They're coming close to it. We did hit, point 0.3 or so over the course of 2020. And right now we have climbed on up. That basically means that the bond market, which typically seems to be correct, believes that the economy overall is going to be doing okay. So when I put all of those pieces together and I basically look at this stuff right here, that there's an extreme shortage of inventory, which we already know that there is. It's about 2 months worth of inventory, and anything less than three is extreme shortage. Uh, that basically means that we can absorb quite a bit, quite a few millions of homes. Now, one thing to understand is that 1.28 million units is 2.3 months supply. So we could take another 2 million units to bring us back to about 5 months, maybe 6 months supply, right? Which is the balanced market. So there can be millions of homes that can actually hit the market, and the market actually will be fine. It actually would reach the healthy stage of the whole thing. So don't fall for the whole, like, the sky is falling that many of the other, YouTubers are wanting to petrify the daylights from you. So I think market is going to be just fine. Again, not a financial advice whatsoever. I can't give you one of those, nor would I want to. I'm just looking at all of the sort of reading the tea leaves in a cup. Let's just call it that. They're actually coffee beans in my case, given that that's a more traditional thing of what one would do where I come from. So, one of the other things that before we go into the most important part of the conversation for the day is to talk about the hybrid appraisals. So, is that going to become a new normal? And I think that there is an argument for this, but before we go into that stuff, we're going to talk about it. So, Federal Housing Finance Agency, FHFA, say that fast 5 times, announced on Monday it is requesting input on the appraisal policies, practices, and processes of Fannie Mae and Freddie Mac, especially as it relates to the GSE's appraisal modernization effort, right? So, what they basically, COVID has done a lot of bad stuff, a lot of good stuff. Bad stuff because obviously we've gone on lockdowns. Many people have passed away that likely wouldn't have. Maybe they would have. Nobody knows, right? But it's done also some very, very good things. It's taught us how to work remotely even in companies that were never even considered doing that stuff. It taught us how to do business differently. It taught us how to communicate and attend classes from wherever we are. And I think this particular event is going to change everything we know about doing business, about working, about buying, selling, going to school and all of that stuff. Way back when, you used to be able to have to, live close to the school so that your little one can go to the good school. I think the future is going to be very different. You can live anywhere in the country and attend any school in the country. How amazing is that, right? So that's number one. And as we get into the VR and AR and all of that stuff, I think that's going to happen even more. Same thing happened with the jobs. You used to live very close to where you work. Now you don't have to. You can live halfway around the world as long as you show up during particular hours or do the job or show up for a meeting. They could care less where in the world you are located. You don't have to sit in the same room. So that has freed up folks in a tremendous way, and of course, one of the things when it comes to real estate and doing business in real estate has to do with appraisals. So, what happened? Well, when the pandemic hit, of course, everybody's like, you got to figure out everything, how you do that stuff. So, one of the things that you have to do with the property when you're transferring is figure out, especially, well, sometimes it's due for the buyer. I think it's a good for the buyer to understand, are you overpaying or underpaying or whatever, right? What are you doing? It's a good thing for a seller. You don't want to undersell your property and lose money into it. But the biggest reason that we have all of these appraisals is actually for the banksters. The banks don't want to borrow more money than what they think is a fair thing. So, of course, they would go in, they would get an appraiser, they would go, do all of the work in, figure out, okay, what does this house has, what does it doesn't have, look at the neighborhood, and then try to figure out how to price this thing and give the appraisal value. Now, the appraisers do have set rules to kind of follow, but at the end of the day, it's a very subjective job anyways, because at the end of the day, it's about the humans. So now pandemic comes in, you don't know how to do this stuff. Now we started doing these hybrid versions of appraisals. And that included like a drive-by. So they would go in, they would get the photos from Zillow or the agent or whatever. They would drive by the property, so they are never interacting with anybody, take a look at the other properties that exist out there and come up with an appraisal. The other processes that also actually happen is that a lot of the lenders waived an appraisal altogether, saying, you know what, roughly speaking, we kind of have our own data. We don't even need to worry about it. When they used to do refinance, they would basically force the appraisal on you. Right now, a lot of them do streamlined refinance where they have a rough idea of what your property is worth, and without doing anything, without any additional cost of appraisals or weird people coming to your house, walking through, uh, all these things, like none of that has to happen. So now the FHFA is saying, well, maybe we need to modernize how we do the appraisal process and look to create more streamlined and accurate collateral valuation process. And so they're inviting a request for input for folks all the way through February 26th, which, by the way, that is how you're supposed to do stuff, Moochie Boochie. And you know exactly what I'm talking about a few days ago when they wanted to roll out this dirty, nasty rule that was like, call for proposals to January 1. I'm like, dude, you didn't even give people 10 days to do it. This is how you do call for proposals, okay? When you want to change the law. But anyways, I digress. So what happened is that they are basically saying, hey, we want to modernize this stuff. We want to see what actually worked, what didn't work from the March. And, they want to basically look to say, can we get a third party individuals to help us with the appraisals? So instead of the appraiser having to go in, we can rely on the maybe a trainee, maybe a home inspector, maybe a real estate agent, right? Like some sort of third trusted party to go in, they collect all of the data, they send it to the lender and to the certified appraiser, and then they kind of go under the automated underwriting system. So it's going to be faster, it's going to be cheaper, and it's supposed to be kind of adding, a layer of faster production into the real estate, which is really, really welcomed and really amazing. There is one of the problems with it is that potentially changing the stuff and adding a third party to the process could have basically unintended consequences. It could problematically change things because within real estate, welcome to the government. Within real estate, and not real estate is not government, but it is regulated by the government a lot. You have different arms of it, and the arms are unfortunately not operated by the same brain, kind of like you. So imagine if you had 10 arms and 5 brains. Well, your brain only controls 2 arms. You have 500 brains who control the other sets of 2 arms, right? And now you want the 10 arms to do the same thing. Well, how do you do that? You actually have to communicate with one another and work with one another. We don't really have that happening in the real estate space. So you have the mortgage section doing something over here, and a real estate agents and brokers doing something over here. Then you have the inspectors over here and appraisals over there. And so you have all these different arms, and none of them are really communicating and working, and they all work in their little silos. And they all charge an arm and a leg to do business. Okay? So that's kind of where we are right now. And so now, if they were to do this, they would actually have to create uniform standards and sets for all these different arms of real estate, which is going to take a while. But I think it is a good move and a move in the right direction. So, alongside its easing appraisal of standards, the FHFA is encouraging lenders to accept appraisal waivers whenever eligible. They never used to do that stuff, but this is the new normal. So, this is the exciting piece that I think is coming, and it's going to modernize real estate to a degree. Now, we're going to be modernizing real estate, whether real estate agencies want it or not. It is coming. And if I'm the one that brings it in, hey, cool. And if I'm not, then I'm just part of the whole thing, hey, cool. But right now, before we go into any of the other stuff, I think we need to go in and talk about what's happening and why and how basically the lack of affordable housing is the it's been brought by the government. This is not something that is, I don't think anybody's evil. Let me put it out there. I don't think anybody's evil. The problem is that there is a lot of regulations and a lot of problems. So I'm going to take you to this particular article. It is talking about the fact, and here is the headline right here. Lots of homes under $100,000 are for sale, but most buyers can't get one for this reason. Now, I don't know if you can guess what the reason is. I don't know if you're watching this live. Feel free to go in and try to guess a reason. Maybe I'll gift you something. I don't know what I'm gonna gift you. A box of chocolates, or maybe I'll gift you a course. I don't know. But anyways, I do want to. Sorry, I'm trying to here organize my life, and it's not. I'm not doing a very good job. But there is a big reason. There's a big reason of what's going on and what's happening. So let's go in and dive deeper, and I will explain as we keep on going along the ways. And I will also explain how you can potentially help and make money along the way. Okay? So, fair enough? So that's my gift to you for New Year's. So there are pockets where folks can become homeowners for under $100,000. There are actually pockets where folks can buy properties for few $100 to few $1,000. Most individuals don't know that. Most individuals, when I talk about it, say I'm full of it and it doesn't exist, but it does. So, and then of course, when they go in and read my books and take my courses and verify, they go, boy, this actually really exists. I'm like, yep, it really exists. So there are homes where you can get homes and become a homeowner. You can get a piece of land. You can get a beautiful little house for well under $100,000. There's one big problem with this stuff. Even if and when you qualify for a mortgage, you often can't get one for under $100,000 because it is typically not profitable for lenders to do small dollar loans and mortgages, as these are called. So what basically has happened is that COVID, like I said, has brought in some good stuff. It's also brought in some not so good stuff. Overall, what it has brought is ability to see much faster, much clearer where the big and giant problems exist. So you have these beautiful pockets where there's homes that are really affordable that folks can get into. And you can right now, if the rates are, say, 2.5%, average is about 2.6, 2.7 for 30 years. If you can actually go in and you can borrow, right? You can borrow, 100,000, and you can borrow, say that it's 100,000 for the ease of math. That basically means that you are paying like what, with insurance and the PMI and everything else. If you're an FHA, you might be paying, I don't know, $700 a month, 650, 500. It just depends on the insurance and the taxes and everything else. But your monthly payment are way less than anything that you can rent of that size and that space, and it's yours, so to speak. You still have to pay taxes and all of the stuff. There's, you got to fix it on your own and stuff, but there are benefits to it because as it appreciates in value, your wealth appreciates alongside with it, whereas you don't have that as a renter. Okay, as a renter, you don't have that. Now, you don't have to be just a homeowner or a renter. You can actually be both if you choose to. But most people just kind of like, I'm talking about the regular old humans right now. If you can buy a home, it does make sense to do it because now you're paying off your own sort of storage of wealth, if you would. And as it appreciates and inflation keeps rising, which it will, maybe not in 2021, but it will in 2020s. It just has to. Okay? It just has to, period. So as that all happens, your wealth actually goes up, your debt goes down. It makes it easier to pay it off and own your little slice of heaven or whatever, right? And later on, you can sell it, you can rent it, you can gift it, you can do whatever the heck you want to do with it. None of which you can do with the rental. So that's my sort of 2 cents for why it makes sense to buy. But here's what ends up happening within these pockets of affordable homes. Investors who don't live in the neighborhoods show up, swoop in, scoop up these properties, buy them all cash because the banks won't lend, and of course, turn them into rentals. Now, I don't have anything about against turning things into rentals whatsoever. I actually do believe that you should have rental property. You should learn how to do it. You should get yourself in this passive income stream space and hold on so you have a store of wealth as well as the income, passive income coming your way. And I think that that's an amazing thing that you absolutely should consider doing. Again, not a financial advice, but it's just something that like just makes sense in my little brain. Okay, more income is better than less income. More income sources is better than less income sources. But there's a problem with some of these things when they come in, that they go in. These are typically the investors that are typically large investors that swoop in, that don't care about the neighborhood. They don't care about what happens. And now you have the locals who are not invested in the area. They could not ask for things. So that's kind of where you have some problems. So I think a healthy sort of combination of investor and owner within the same neighborhood is really, really important for both the investor and the owner and overall health of that market and that neighborhood. It's very, very important to have that stuff. So it's important also to then have and offer small dollar mortgages in the areas where these homes exist, especially if we're wanting to make an equality a bit more thing of today and the future than it was inequality that we are seeing today. And we're seeing a huge disparity, especially when it comes to age, when it comes to race, when it comes to gender, when we are seeing this giant wealth grab, and there's needs to be sort of shortening of it. And so for many, that's going to be through the equities, that's going to be through the cryptocurrencies, and that's going to be through the real estate. So we're talking assets. You have to own assets. Your TV, not an asset. Pair of new sneaks, definitely not an asset. Then your car, unless you're a car dealer and selling it, not an asset. Sorry to break your bubble. You got to go in and you got to get yourself into assets. All right. So that's one of the things you have to do this. So what happened? Well, there's plenty of the homes that are very, very affordable. There are they were basically saying that there's were more than 50,100 listings nationwide for single family homes priced at $100,000 or less. This was in November of 2020. 50,000 properties that are priced below $100,000. Now, they're not foreclosures, they're not tear downs, they're not some of these deals that I teach in my courses and books. These are just homes, right? Like home homes. That's it. They're often smaller in size, and they are often in smaller towns, mid-sized cities. Often you can also find them in rural areas or even in suburbs of some of the towns. So you get a bit more space and you get a very affordable home. Just 8.9% of all mortgage maids for owner occupied home were less than $100,000 in 2019. Nearly 475,000 homes priced below $80,000 were sold, according to the Census Bureau. And of those sales, about 43%, or around 200,000, were financed with a mortgage. So that lets you know that when we are, when we're seeing these homes, they are out there, they exist, but there is a huge problem, and that is obtaining a loan. Okay? So the pandemic, well, the pandemic has sped things up and made things more obvious and even more challenging. So what happened? Well, the pandemic saw something absolutely insano happen with real estate. And that is that the property supply started to go down, property demand started to go up. We just talked about the fact. What does that do? Well, that brings up the prices, and it brought the prices up as much as 15% in one single year, almost unheard of. Typical is 3 to 7%. That's your typical what happens in real estate year over year. And it doesn't sound like a whole lot. But when you do that and accumulate it, it's called compounding. It is a lot, I assure you of that. Some of the $1 million homes you see today were purchased for only a few $1,000 not that long ago. So why not you and why not today? Well, that's because maybe you can't afford to buy one of these mega $1 million mansions. And if you can afford to buy thousands, under 100,000, here is what the problem is. So as the prices started to go up, people started to go and wanting to borrow. When they went in to borrow money, what happened? Well, more money was being the loans were actually being bigger, right? So you go in and you request a loan for 200. I show up, I need 250. Peter shows up and he needs for 225, and Susie shows up and she needs 300. And so as the property keeps on going up, the amount of loans being borrowed keeps going up, right? You got to keep up with the price of the home, right? Because you're only going to be able to put in that 10%, 20%, 3.5%, or whatever what's going on. So that's what ends up happening. So business started booming for the lenders, which means they can become pickier. So that means that the lender is like, do I lend you for the small dollar loan of, I don't know, $60,000, or do I do the same amount of work and make a loan for $600,000? Well, if you were in that situation and you can only make one, and your income depends on the size of the loan that you make, which one do you make? Well, you make a big one, right? If you're smart, you make a big one. So number of purchase loans was up 26.3% annually in the week ending December 18th. Refinances were up a whopping 124.3% year over year. Average person's loan was for 376,800 in the week of ending December 18, which is about four times, almost four times, the price of the small dollar loan of what you're trying to do. What this means is that those looking for less expensive, humbler loans are competing with lenders' attention for those that actually want to buy something more expensive, right? So again, put yourself in the lender's shoes, just like we talked about. You are the lender. You have me and Bob. Bob is saying, I need a $1 million loan, and he can get it, right? I need $100,000 loan. I can get it too. I can qualify. But you are going there and saying, well, I make 1% of all of these loans. So do you want 1% of 100,000 or 1% of a million, right? It's an easy math. It's an easy thing to consider. At the same time, then the lenders are also tightening the purse strings. This is the part where it could be actually quite interesting for you to get in. So, my little coffee. If you are an investor in any way, shape, or form, you're thinking about being an investor, we are starting to enter, slowly but surely, we're starting to enter into the phase of potential where it might make sense to become a private lender. That's right. So, private lenders are basically also known as asset based lending, where you lend your money, your cash that you have, onto a particular asset. The asset is the underwriting goal of the whole thing, where you can go in and basically lend up to a certain percentage of the money. And, you don't really own much of anything. You don't have a home. You don't have to go maintain it. You don't have to go clean it. You don't have to deal with tenants. You basically just have a borrower, and you have a piece of paper. You put it in your filing cabinet, and every month you receive a check. Every month you receive a check like a clockwork, just like a rent, except you're not dealing with tenants. You are dealing with a borrower. And if the borrower, because you're asset-based lender, if the borrower doesn't pay you, you then have a legal right, not obligation, but a legal right to go and foreclose on a property or the asset that you have purchased. So if you say, for example, you borrow $50,000 on an asset that is worth $100,000 and they don't pay, guess what? You just doubled your money because they didn't pay. It's a super simple and a fun game to play. Of course, it's much simpler if they just pay you off, because if they do, well, then you collect the 5%, 10%, whatever agreement is with you, the return on your money, and just get the passive cash flow without having to do anything whatsoever other than just check your mailbox if you want to do the check version, or you can check your Venmo account if you want to do the digital version, or you can check your crypto wallet if you want to go the crypto version, right? So the choice is yours of what you want to do, but we're starting to enter a phase where it makes sense, and it's starting to make sense to do that stuff. Now, if that is something that is of interest to you, I'm actually slowly but surely in 2021, I'm actually going to be developing a course on how to do that stuff. So if you are interested in that, hey, go into the One Deal Away, and let me know. Let me know. Go over to the contact page and just shoot me an email. Let me know if this is of interest to you, because not only will I be teaching you, but as you know, we are developing a platform on which folks can actually get into some of these super cheap deals, and super fast, super cheap, super secure, super amazing. And of course, we do want to do borrowing and lending as well. So that means we need the homeowners, we need the buyers, we need the sellers, we need the lenders, and of course, borrowers will come wherever there's money. So, and of course, the lenders will come wherever there's borrowers wanting to get money and be willing to pay the interest. So, something of interest to you, do hit me up. Don't forget to do that stuff. But let's continue with the story. So, this is the part that is very interesting here. Lenders are tightening the purses, okay? This is why it's important for us to think outside the box and say, it might be time for me to start becoming a lender, and I don't have to focus on these giant assets, right? I can focus on smaller ones. I can focus on $100,000 or less, right? So why don't they actually go in? Why does it cost more money to lend less money? Why are they not doing small loans? I used to ask that question all the time. I remember back in 2008 when the market crashed, and I was like, holy crapoli, there's some amazing deals. Like, I've gotten one, I've gotten second one. Like, can I get more? Can I get more? Please. I didn't have that much cash. And I would go in and I would beg and plead for them to basically lend me money. I showed up with business plans. I had everything ready to go. I mean, I was ready. Nobody would have made a mortgage under $50,000. So you had these homes, amazing homes that are selling now for $200,000 to $500,000. They were selling under $50,000 12 years ago. Talk about gains. Talk about insane gains, okay? But nobody would borrow, nobody would lend less than $50,000, right? 50,000 was the absolute minimum. There was one bank back in 2011. They were struggling so much that decided they were going to, this was in Arizona. They decided they were going to make a loan to a colleague of mine for $35,000, right? $35,000, a beautiful home. The lady retired. I mean, talk about amazing stuff that happened. But anyways, so why does it cost more money? Well, making small loans becomes more expensive for lenders after the housing crash. New regulations were implemented to quote unquote prevent another financial crisis, and they cost lender more, like way, way, way more. To originate these loans, the cost actually keeps going up, and it goes up every single year. Here is the part where the government is actually stepping in. They write this beautiful little law. Everybody raised their hand and says, yes, 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 we got to do this, we got to do this, we got to do this. And then problems ensue down the line because oftentimes we don't really see what that law does to us in the future. This is part of the problem that we're seeing right now, even with these stimulus checks. And while I do, I'm going to take the free money that the government gives me all day long. Send it my way. Heck, you want to triple it? I'll take it. You want to 10x it? I'll take it, right? But it's not good. It's not good overall. And, excuse me, it's definitely not good for the people, and it's not good for the middle and lower income class. Whom it benefits? It benefits the wealthier individuals once you actually shift over the threshold. But you got to shift. That's the part that is actually hard. You got to climb up the damn mountain, get onto the top, and then slide back down to get onto the other side of the whole thing. Okay? So here's what happens. Loan officers typically paid by earning 1% of the value of the mortgage they make. So, you make a mortgage for 70,000, you make 700 bucks. You make a loan for 700,000, you make 7,000 bucks. The work exactly the same. Which one would you do? Of course you're going to do a bigger one. You're going to do a bigger one all day long, all day long. However, here is the part. Even if you were like, well, I'm a good person. I'm a very good person. I'm going to do this $700 loan, right? I'm going to do this. I don't care if me and my family don't eat. Here is part of the problem. You might not get the full $700 pay, right? You make that 70,000 loan, you are supposed to get 700. However, the law also put in, here's the part, the tricky part that goes in that basically, pardon my French, but screws everybody. That fees are supposed to make only a certain percentage of the entire loan. And fees is what is actually driving these things really, really high. If they exceed the threshold, the loan officer's commission actually ends up being cut. And so if you make something really low, like $50,000 or less, you don't get paid at all. And sometimes you actually have to pay to do it. That's why they don't do it. Okay? So now you're like, holy mother, I understand this stuff. Okay? So when adding in fixed costs, and what is in the fixed cost, right? Because it's not just the purchase of the home. Here is part of the problem with the real estate industry as a whole. Aside from it being treated like a secret brotherhood of sorts, right? Where you got to know the secret knock and a secret shake and a secret whatever you got to do to get in, it's it's almost impossible to break into it, right? So you got to be on the inside to do it. The second part that is also very challenging is that there's a lot of fees that end up being tackled on. If I wanted to sell you my house, right, and you wanted to buy it, you and I, in a normal circumstance, could find each other, right? You could find me, I could find you, you find a house, you're enamored with it, and you say, okay, Nev, I really like your house. I'm going to buy this thing. You end up buying the house, right? I end up selling it to you and say that it's 100,000. You pay 100,000, I receive 100,000, I pay off my mortgage, done deal, right? But that is not how it works, okay? Inside the real estate space, you have all kinds of things. You have appraisal. Well, that costs money. That doesn't come for free, right? Now, you may not have to pay for it the moment that the appraiser shows up, but I promise you, when you're doing the buying and the borrowing and financing, they include it in it. Then you have the processing and underwriting fees, which is just another fee to collect the money. Okay? They don't have to have that. They don't have to have it. They have it so that they can make more money. Period. End of conversation. That's it. It's that simple. It's that simple. Then you have, inspection costs. Then you have the escrow costs. Then you have the title costs. And when you put all of that up and together and into the fees, the lenders actually end up losing money on loans that are $50,000 or below. So they don't do it. They simply don't do it. And as these costs keep on rising, and they are, the threshold of where they will stop actually making loans keeps on going up. So that is why affordable housing is basically a joke. When the government officials talk about affordable housing, are really talking about affordable rentals, right? They want to get you in affordable rentals. They don't want to get you into an affordable home. But here on this channel, I want to get you into a home. I want to get you into the least cost option to get into your home, to buy your house, to become an investor, to become a landlord, to have a place to live, to be able to actually benefit from beautiful, amazing thing called real estate that exists out there that gives you an opportunity to make quite a bit of wealth, not just actually preserve your wealth, but also make it. Two combinations, okay? Both. You need both. You can't just go with one. You have to have both. So what happened? Well, there was a small dollar lending program that was actually launched this summer, and they launched a micro mortgage marketplace, and it began offering small loans over the summer. Sounds exciting, right? There's a problem. They are yet to make a single loan. They only had 4 applicants whatsoever. Okay, 3 of them got denied because their credit was so bad. One decided to go with a different lender because, well, what happened? Well, even though they don't require down payment or mortgage insurance, around 4.5% for the 30-year fixed. Well, that's really high in today's market. Now, they did bring it down to 3.99, but now with the average being about 2.5, 2.6, that's still really, really, really expensive. So we'll see kind of how that rolls out. So if you are willing to actually go out there, market yourself, make loans that are much more compatible with what we're seeing in the marketplace, and we can do it without these crazy appraisals. We can automate the escrow. We can automate all of the different components that exist out there. Then we have something going for ourselves. And that is exactly what I am working on building over here. And I'm super, super excited. In 2021, we should be rolling that puppy out. I'm actually going to be working on it over the holidays as well. So a little bit of break, I won't lie, a little bit of break, but overall, that's kind of what we're working on. So I do want to tell everybody for watching this, for being part of the show, for supporting me, for subscribing on the whole thing. If you're brand new and you haven't subscribed yet, I do invite you to subscribe. If you're liking the show, if you're learning anything, hey, tell other folks about it. Do hit whatever like button, subscribe button, whatever button that there is, and I will see you in 2021. I do wish you the happiest of the New Year's. And here we go to 2021. I'm actually going to toast to you with my cup of coffee. That's right, with my pure black cup of coffee today. No cream, no sugar whatsoever. Just black coffee, um, how I wanted it. So, Happy New Year. May you, your family, and everybody you care about and even don't care about, may you be prosperous, may you be happy, may you be healthy, and Happy New Year. Until then, stay forever next, stay forever money blessed, and do remember, you are only one deal away.